All right, welcome to the Money Multiplier, becoming your own banker, infinite banking concept, full what we call 90-minute training. So I'm going to be with you for the next 90 minutes going through what infinite banking is, why it's been used for over 200 years in this country by some of the wealthiest families and individuals and some of the most successful people out there, and how you, regardless of what your situation is, you can implement this into your life right now, and it will put you in a better financial position moving forward when it comes to not only you, but your family and creating that legacy as well. So I'm going to show you exactly how to do that over the next hour to hour and a half here. So as we get going, if you have any questions, put those in the Q&A box. I'll be asking you questions in the comment box. So interact with me, have some fun with this. Over the years, I've learned that you can really learn a lot better by interacting and responding to questions and things like that. So, in a live audience, it's a lot of raising hands and responding that way. In the virtual world that we now live in, it's a lot of just putting your comments in that chat box and putting your questions in the Q&A. But I'll answer your questions as we go. And if I don't answer it as we go, at the very end, I promise you I will answer every single question. We have full transparency in everything that we do. So I'm happy to answer all your questions. I've been doing infinite banking and helping people get started with this concept and implementing it in my own life for 3 years now. And I've been in the entrepreneur and business and investing space for 14 years now. So I'll talk a little bit more of that as we go. So, all right, let's get this rolling. If you're watching on Facebook, this is a Zoom meeting. So I'm not monitoring Facebook. So if you're putting comments in the chat box on Facebook, I'll see that later when I check my Facebook. So you need to come on the Zoom meeting with us for the next time. And we do this every single Tuesday at 6 p.m. Eastern. So feel free to invite your friends and family to the next one. Now, next week, I will be with my wife on Palm Beach. We're going to be at a resort for a few days. So I'm not going to be doing this myself next week, but I will have Hannah Kessler, who a lot of you guys know Hannah. She's going to fill in for me next week, next Tuesday, and she's going to do a presentation for you guys, very similar to this one. And then I'll be back the following Tuesday and every Tuesday thereafter until my next trip or vacation. So with that being said, let's get into this. All right. So again, I'm Stephen Nagy. That's my cell phone, my email, and we'll talk about how you guys can get these free bonuses and resources here in a little bit. So what we're going to talk about here tonight is the infinite banking concept. But why it's so important right now is we have a lot of crazy stuff going on right now with the economy. We have a lot of global issues and challenges and supply chains. Inflation in this country is around 8.5%. Real inflation is definitely double digits, probably over 20. When we look at the housing market, that's double. When we look at the price of gasoline and where that's at, things are going crazy right now. It's a lot of volatility in the stock market. The stock market's had a rough start to 2022. A lot of people are getting their quarterly 401k statements right now, and they're like, holy shit, and they're starting to panic and things like that. So there's a lot of volatility, a lot of craziness out there. Nobody really knows what to do right now. How bad are things going to get? Are we going to see a recovery? Are we going to bounce back right now? Is it going to take a decade to bounce back? Well, whatever happens, all I know is you need to be prepared for it. And right now is the time to do that. So I'm not going to spend a lot of time going into the economy and the opportunities, but I'll say this right now. I truly believe that over the next 3 to 5 years, we're going to see a lot of changes happen in this country and in this world. And I think we're going to see some rough times coming up. We're going to see a stock market crash. We're going to see real estate start to pull back and probably see a crash in real estate at some point as well when it follows everything else that's happening. And, whether it looks similar to 2008, whether it looks similar to 2000, whether it looks similar to the Great Recession in 1929, that's yet to be seen. But I think regardless of what happens, we're going to have a lot of opportunity. So now is the time to understand, where is our money going? Where is our money that's available to us for investing? And how do we start taking back control of that money? So when these opportunities do start to arise over the next 1, 2, 3, 5 years, we're ready to deploy that money and get in. Because there's something that I know more than anything. Whenever we have these changes in the economy and we have these times of things that are crashing, when there's blood on the streets, so to say, that's when millionaires and billionaires are created. We do a lot of real estate investing. We talk a lot about real estate, whether it's passive or active investing. We talk a lot about getting into the stock market when prices are very low, doing things like options trading, things like that to really utilize what wealth we already have and really just snowball that and set ourselves up for the future. So right now, tonight's gonna be very relevant for that, because I'm going to show you exactly how to put your money somewhere where you have complete control of it, but it's going to continue to grow for you even before you start using how to take back banking functions in your life, how to take back where instead of giving all that money to all the banks and finance companies, all the interest that people give out, how to keep that within your financial future. And ultimately, I'm going to show you here tonight how to not work any harder, how to not work any longer, how to not take on any more risk, but how to create wealth and really strong wealth for you and your family moving forward. So that's what this is all about. Now, if you want to learn more about the economy and you want to get more into the markets and what's happening and things like that, join us tomorrow. We do 3 webinars every Wednesday at 9:30 a.m. We do What the F Happened podcast. So Chris is in Aruba right now. So Larry Steinhaus is going to join me tomorrow. And we're going to talk all about the state of the United States of America right now, the state of the stock market, the economy, politics, policy, and what's going on in the US. So join us tomorrow morning. You can watch that. It's a live stream on YouTube at the Chris Naugle or the Money School TV YouTube channel, on my Facebook, Chris's Facebook, and all the other social media channels. So you can watch that tomorrow. And then 1 p.m., we have our wealth webinar Wednesday, every Wednesday at 1 p.m., where we talk about strategies for taking back control of your money. So this week is going to be about passive investing and creating a nice monthly return for yourself. Next week is going to be self-directed retirement investing. So how to take back control of your retirement accounts. So again, that's not stuff I'm talking about tonight. Tonight's all about becoming your own banker, but just wanted to kind of explain where we're going to teach you about this. And then of course, at the end of July, we have a live event in person in Buffalo, New York. It'll also be a virtual option. So you guys check that out. You can find that at chrisnaugle.com and join us in Buffalo at the end of July for a live full 2 days of training plus a third day of networking. So check that out. And those kinds of trainings that we put on our Money School Essential trainings are what really get into all the other strategies and how all of this works together. All right. So let's get into this. So Brent Kessler, something for me, and I would recommend to everybody on here, is find mentors. Find people in your life that are doing what you want to do. Find people in your life that can teach you strategies that they're doing themselves that are proven to work. Not only that they've proven to work, but have been proven to work by history. History proves that it works. And Brent Kessler is one of those guys. So Brent Kessler, when it comes to BYOB specifically, and what we do with the infinite banking concept, Brent is my mentor in that. So find yourself a mentor, whether it's Brent, whether it's myself, whether it's Chris, or whether it's our team. We all work together in this. We will be your new mentor team when it comes to becoming your own banker. And Brent has an incredible story. You guys can go check it out at themoneymultiplier.com. But Brent was a chiropractor, had several clinics, made very, very, very good money, but also ran up almost $1 million in third-party debt. And he knew that he wanted to tackle that. So he used the infinite banking concept to pay that off very quickly. While building wealth for his family, and then started sharing it with other people, chiropractors that he worked with, his partners in the chiropractic world, and it started working very well for them. So he created the Money Multiplier. And now Brent flies around in his little private airplane and does live training events and teaches this stuff all across the United States of America, alongside myself and Chris as well. So Brent's an incredible guy. I just wanted to give him a shout out before we dig into this. And you guys will get to know Brent if you haven't already met him. And then Chris Naugle, if you're here tonight, you probably know Chris, have found him on social media and are following him. So go to chrisnaugle.com. Chris is an amazing person. When I first met Chris, this was one of the first quotes I ever saw that he had up. And so I've always used this because this relates to me more than anything else. And it says, it's never about your actual resources. It's about how resourceful you can be. And that's so relevant for what we do with becoming your own banker and taking back control of your money, because our entire thing that we do at the Money School, our motto, so to say, our mission is teaching people how to take back control of their money and solve your money problem. And one thing that I've found is everybody has a money problem, whether it's somebody that's 50,000, 100,000, $500,000 in debt and barely getting by paycheck to paycheck, or whether it's somebody that has millions of dollars in the bank, has a successful business or practice or something like that. It's just, they both have a money problem. It's just a different type of money problem. This person over here that's in all the debt and barely getting by, obviously needs to generate more money. They need to actively go out there and do things like start a business or invest or get into real estate investing or do something to be able to generate more income for themselves, and then be smart about that income that they're generating, where that money goes. So into things like this concept I'm here tonight, where you can start that uninterrupted compounding growth while simultaneously continue to use it in your business and in your investing. Or on the other side of the fence, somebody that has a bunch of money, well, how do they protect that money? How do they pay less in taxes? How do they stop giving it to everybody else? How do they control that money and get consistent, predictable returns for the rest of their lives and grow that money consistently without the volatility of things like the stock market? So depending on what side of the fence you're on, the wonderful thing is this strategy will work for both of you, for anybody, no matter which side. And then the other strategy we teach with Money School, as far as like real estate investing and passive money lending through the Private Money Club, and the other strategy that we teach like that, those of you that have money, get that money working for you and making more money. And when we match those people together, like we do in the Private Money Club, that's when magic happens. So just keep that in mind right now. It doesn't matter where you're starting. It doesn't matter what your actual resources are. It's how resourceful you can be. And that'll be really very, very relevant in everything that we teach you when it comes to the Money Multiplier and the Money School. And this right here is one of my favorite quotes. The problem in America isn't so much what people don't know. It's what people think they know that just ain't so. So that was said by Will Rogers. And it's so relevant because, we've always been told our whole lives, for example, like, go get a job, invest in a 401k, climb the corporate ladder. Someday you'll be able to, retire with your retirement and Social Security and live that life and things like that, right? I mean, we've been told that our whole lives. And I could go on and on with different examples like that. And so because we've been hammered into our minds and into our heads over and over, year after year after year, our entire lives, it's so easy just to think, okay, that's the only way to do things. I have to go out and play it safe, quote unquote. How safe that is, right? But, we're told this stuff. And so when I introduce concepts like self-directed investing, and I introduce concepts like becoming your own banker and taking back control of your money to people, the first thing a lot of people want to do is, no, that's a scam, or that's gimmicky, or that doesn't work. How could that work? There's no way. If that really works the way that you say that it works, I would have already known about it by now. Listen, I was a financial advisor, fully licensed, Series 7, Series 66, full variable annuity, life health, insurance licenses, full 9 yards, guys. And I was never taught this stuff then by Ameriprise Financial. I was never taught this stuff in the securities exam or anything like that. So this stuff's not taught. I went to college. I was never taught this stuff in college. So just because you've heard something your entire life and it's always been done that way, doesn't always mean it has to be done that way. And it doesn't mean that there isn't a better way to do it. So keep that in mind as we go here, because a lot of what I teach you here tonight is a change in mindset. I'm teaching you how to change the way you look at the banking functions in your life. I'm teaching you how to stop using banks and taking loans from finance companies, and how to take back control of that and fund your own stuff. Like, this is the stuff that really works. And how do I know this works and that the old way of thinking does not work? Well, it's because the Social Security Administration tells us that if we take 100 people in the United States of America at retirement age, that only 5% of those people, 5 out of 100, are going to actually be able to retire the age and the lifestyle that they want to. And before I learned about the Social Security Administration coming out with this statistic, I saw it myself firsthand. I mean, as a financial advisor, I was meeting with families and discussing with them their retirement. Like, how do we get to, what are your goals? Like, what age do you want to retire? What lifestyle? How much money do you need? What's that look like for you, right? And then 9 times out of 10, we would have to have the discussion, well, that's not going to happen. You're either going to have to save more money now and drastically change your lifestyle, stop spending as much now so you can save more. You're going to have to take on more risk, or you're going to have to push back retirement age. That's the only way to be able to get them to where they want to go. Well, one of the beautiful things that we do with the money multiplier is I'm not going to tell you that stuff. By putting your money, funneling your money through one of these policies first, you're not going to have to work any longer. You're not going to have to work any harder, and you're not going to have to take in any more risk. And that's one of the beautiful things about taking back control of your money. So I'll show you that as we go here. But I just wanted to point out, and when you think about just life in general, right? Like, how many times do you do something and it ends up like 5% of that group was actually successful or actually followed through with what they said they were going to do? I mean, we'll market events. Like, we'll do a live event somewhere and we'll do a bunch of marketing. We'll have a bunch of people register for it, whether it's in person or online. And if we do something and we do all this marketing, it's literally 90 to 95% of people don't show up. So when we're looking at numbers, it's just, so when you look at it, it's time and time again. So don't be like that, right? Be part of the 5%, be part of the successful people that learn something, take action, implement it, and create success in their lives. And, on top of that, what I found over the years of working with people, I've been doing this for 14 years now, and I've really boiled it down to why aren't more people successful? And this is very important right here. The top three are what we teach in money school. So taxes, inflation, and volatility. So how to start eliminating taxes. I mean, Warren Buffett said it best, right? Warren Buffett said, it's amazing that I pay less money in taxes than my secretary does. And my mentor when it comes to taxes, a guy named Solomon Halamani, who does 1041 tax reporting. What he says is there's two tax laws in this country, one for the informed and one for the uninformed. Both are legal, right? There's a reason that the tax code book is literally like this thick. It's not like a couple pages. If they wanted to make it fair for everybody, it'd be one page. Everybody pays the same, but they don't. They want to reward the wealthy. They want to encourage businesses. They want people to go out there and do things differently. So why aren't you doing it? Right. So this is stuff we teach in money school, and I'll get into it a little bit here tonight, but, eliminating the taxes, things like keeping your money moving at all times. Inflation will be very, very relevant here tonight, because I'm going to show you how to put your money into a place where it's compounding and outpacing inflation while simultaneously using that money and keeping it moving, where you don't have to worry about inflation anymore. It doesn't matter what inflation does, because at the end of the day, as long as you're treating your money the right way, inflation doesn't matter. Volatility, that's when you just got to understand you don't have to ride those waves in the stock market, your retirement accounts, things like that. You don't have to ride those. Buy low, sell high, and don't lose money. It's as simple as that. Another quote by Warren Buffett right there. So volatility, get that out. Over the long term, fine, if you want to let it ride. But guess what? If you come up to retirement age and you're planning on using that money, and all of a sudden we have a stock market crash, guess what? Your retirement account's going to crash right along with that thing, and it's not going to be pretty. So those three right there are just financial education. Again, financial education, unfortunately, is not taught in this country in college or elsewhere. You got to seek it out. But the good news is people like us are teaching it on a daily basis. One thing off topic real fast, if there was like two questions in the Q&A box before the whole thing shut down, those questions disappeared. So please put those questions back in the Q&A box so I can answer those. So the bottom three on why aren't more people successful, this is kind of more mindset stuff, following the status quo. We talked a little bit about that a second ago. Fear is just, scared to do something different. Oh, what they're teaching me here tonight, well, I never learned about it before. I don't really understand it, so I'm not going to do it. Hey, I agree with you 100% on that. If you don't understand something, don't ever invest in it. Don't ever put your money into it. Don't ever do that. But with a little bit of education, joining us on a couple of these webinars, watching some of our other trainings and case studies on the YouTube channel, having support, we're your team moving forward. We don't charge for anything that we do either. So hop on the phone, send us emails, send me a text, but let us help you. And what I found is if you get educated and you have support there to help you understand and say, hey, it's okay to do this. You don't have to do it on your own. Fear goes right out the window every single time, 100% of the time. So put that support team in place for yourself and fear will be gone. Now, life is the one that we can never prepare for, because accidents happened, emergencies happened, shit happens in life, right? Who said that? Forrest Gump? but shit happens, right? So life is the one that we can't always completely predict, but we can prepare for it. So if we set our money up and we structure our finances properly, when life throws us those curveballs that we're not expecting, we can still be on the right track. We might have to pivot a little bit. We might have to do something to overcome that roadblock in life. But at the end of the day, it's not going to crater us. It's not going to ruin us. And that's the goal. So those top five ones are right there. I can teach you, I can help you with every step of the way. And when it comes to life, I can help you at least prepare to where it won't be financial ruin for you and your family, but and we can pivot along the way. So moving forward, I don't want you looking at this stuff as excuses. These are no longer excuses that you can use. We're going to teach you every single one of these where you can move forward and not worry about those moving forward. And the way we do that is start changing our mindset a little bit. So what I want you guys to do after this is go on YouTube and type in the backwards bicycle. It's an 8-minute video, but it's amazing. And what it does is it just shows us how our minds work. Because if we're told something our entire lives, again, you're going to try and fight back on it. You're going to say, no, 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 because it's new, because it's a different way of thinking and a different way that your mind works. And this backwards bicycle video on YouTube kind of shows that. And it uses a bicycle to do so, but go check it out. It's really, really cool. So that's one thing. Start thinking about things a little bit differently. And just understand that it is going to take over and over and over hearing something sometimes to finally get it. So hop on. We do 6 live webinars for free every single week. Start hopping on those live webinars. We put out new content every single day on YouTube, on our social media channels. So just start getting around the campfire. We call it the campfire. The more you can be around the campfire, the more that this stuff is going to start to click for you, and the more it's going to become second nature. And when money becomes second nature and investing and finances become second nature for you, that's when you'll be able to really start creating the success that you want and that you need and that you deserve in your life. So these are some other great ways. Read, listen to audiobooks, read financial education books. Robert Kiyosaki. Do you guys like Robert Kiyosaki? Absolutely love everything that he's ever done. The Rich Dad, Poor Dad series, the way that he looks at money, his advice when it comes to owning homes and tapping into equity. And this concept right here, he talks all about in his book, Second Chance. The cash flow quadrant. Changed my life learning about the cash flow quadrant and what he teaches in Rich Dad, Poor Dad and the book, The Cash Flow Quadrant. So check out Kiyosaki, but this book specifically, Second Chance, he talks all about the infinite banking concept in the book. Tony Robbins, unbelievable guy when it comes to mindset and positivity and motivation. And in his book, Money Master the Game, he talks about the infinite banking concept and the power of implementing this in your financial life. R. Nelson Nash, who I consider the godfather of the infinite banking concept. Unfortunately, he passed away a couple of years ago. We lost a good one in that guy, but he really brought this to the masses and talked about it in a way that everybody can understand. So that book right there is like the Bible when it comes to the infinite banking concept, becoming your own banker. So definitely go pick up that book. I have it, a hard copy of it. I have audio copies of it. I have it on my Kindle. It's just an unbelievable book. So Chris and Brent wrote an updated version to Becoming Your Own Banker called Mapping Out the Millionaire Mystery. So definitely check that out too. Actually, we'll send you a free copy of that book, Mapping Out the Millionaire Mystery, if you just pay shipping, a hard copy. Or if anybody wants to get the digital copy for free of that book, all you got to do is send me a text or an email letting me know you want the free digital copy of Mapping Out the Millionaire Mystery. And I'll send you a free copy of that, as well as a free digital copy of Chris's book, The Private Money Guide, which is all about private money lending. And then I'll send you some other bonuses, some other resources as well. So yeah, so you guys text me or email me and I will get that stuff to you. So again, one more time, here's my email and here's my phone number. And then actually more importantly, if you send right here, if you just go to the moneyschoolrei.com/Snaggy, I will actually, it'll automatically send you all that stuff right there. So you can do that right there as well. Money School REI. I'll put it in the chat box. moneyschoolrei.com/Snaggy. And that will that'll get you a copy of all that stuff right there, just as a thank you and a bonus for being here tonight with me. All right. So with that being said, again, I'm Stephen Nagy. I've been, in real estate, still an active realtor, have my licenses. I work with a really cool team out of Palm Beach Gardens, Florida right now. Shout out to John Scholler, Eric Sane, and Chris Christodoulou. Been doing this for 15 years in the investment and financial education space. I've had a chance to travel all across the country, spoke on many, many stages, worked with individuals now in 50 states, as well as Canada and Mexico. And we live down here in South Florida, in the Jupiter, Florida area, if you guys are familiar with that. I have a 6-year-old son, and my wife has been a teacher for the last 13 years. She teaches kids with autism, and very active, and going to continue being active in that community, helping children with autism. And she's looking to join the board of the school that she taught at. But congratulations to my wife. She just retired after 13 years of being a full-time teacher in the public education system in Florida, and is retiring and starting a business that we're actually using one of our banking policies to fund the purchase of this new business. So she will be learning business and getting into that. So that's me and my family and my life. And like I said, very transparent. I'm an open book. So if anybody wants to know more about me, happy to share with you at any point. The mysteries of money. One thing that I've learned over the years is that a lot of people kind of get a little uptight and nervous when it comes to talking about money. And I think one of the things like that is just over the years, kind of going back to like how we think about money and finances and investing and what we've always been taught before. Something in the past has always kind of been like, don't talk about money. Don't ask people how much money they make. Don't ask people like what they invest in. Don't talk about it and things like that. And I think a lot of that's kind of going out of the window these days. Like, why not talk about that stuff? So, when it comes to the mysteries of money, a lot of it's kind of shrouded in secrecy and things like that. But once you understand, money's not some magical thing. Like money can't buy you happiness. Yeah, maybe not, but I guarantee you're going to be a much happier person in life with access to money. So at the end of the day, money is simply a means of exchange. It's nothing magical. It's, let me give you this money, whether it's a dollar bill, whether it's crypto, whether it's this pen, whether it's, I'm in blurry right now. You can't see me behind me, but I have a dresser full of a bunch of silver and gold that I've been collecting here lately and stacking. So no matter what it is, at the end of the day, money is simply a means of exchange. And once you kind of get rid of the mysteries and the secrecy around it, it's a lot easier to start being able to take back control of it and do a lot of the stuff that we do. So, keep that in mind as we go. And so, we start asking questions like, are your dollars worth more today or in the future? I mean, what do you guys think? Is your dollar worth more right now today or next year? What do you guys think? It's obviously today because Moses, today, Raul, today. And because of that, because of things like inflation, inflation is simply a eraser of the purchasing power of the dollar. Essentially, inflation just basically makes, what I'm able to buy today is going to cost more next year. Like, think back, what did a gallon of gasoline cost when you started driving? What did, I was talking to somebody the other day, like, what did a carton of cigarettes cost, back in the day? I mean, back in the day, it was kind of like the cool thing to do was smoke cigarettes. I mean, I'd fill up my gas tank when I started driving for less than $1. And I could go buy a carton of cigarettes for $17. I mean, last I looked, it's like 60 or $80 or something crazy. I haven't smoked in many, many, many years, but just to give you an example, I mean, what did a candy bar cost? Like, you give so many examples of this. And so why do we put our money in places where we give up control of it and not touch it for many years? I mean, think about this as an analogy, right? Like, if you were to go buy a loaf of bread or buy a gallon of milk right now at the store, Like you wouldn't go just stick that in the freezer and not eat it or drink it for 10 years or 20 years or 30 years. You'd eat it and drink it right now, right? So why do we do this with things like 401ks and retirement accounts where we're sticking our money somewhere? And again, what do taxes do? Taxes go up or down every year. It seems like taxes are always going up. So in a 401k, we're putting our money somewhere where if I pull it out to do something else with it, they're going to charge me a 10% penalty. I'm going to pay taxes on it later when taxes are going up all the time. And I'm giving up control of it, giving up the purchasing power and the investment power and the power of the dollar to where I can't touch it without being penalized until I'm in retirement age. So like, why do we do stuff like this? And it's just, so when you start getting rid of these mysteries of money and what it all looks like and understanding how to take back control of your money, a lot of this stuff starts to make a lot more sense. So let me ask you this question. Can you make money earning 4% while paying 6%? What do you guys think? Yes or no? If I was to tell you right now, I am going to pay you 6%, or you're going to pay me 6%, and you're only going to earn 4%. Do you think you can make money? Yes or no? Tess, yeah. All right. So all my people that have been on this webinar before have the right answer. And if you're new to this, you're probably thinking to yourself right now, well, these people in the chat box are crazy. And I obviously joined a group of crazy people here tonight because there's no way in hell that I can make money earning 4% and paying 6%. And if you're thinking that right now, don't worry, you're not alone. Almost everybody, when they first see this, says the exact same thing, including me. But let me show you what I'm talking about here. So if you have $25,000, just let's use buying a car as an example. Everybody can relate to buying a vehicle, right? So let's just say you have $25,000 and you want to buy a car right now for $25,000. So you have $25,000 sitting over in this bank account. So this is just a regular old bank account. Now it's kind of a magic bank account because this bank account is paying you 4% interest in a savings account. All right. Now, we all know you're not getting 4% interest in a savings account right now, but let's just pretend for the sake of argument so I can prove my point to you. So you go to the bank and you say to the bank, you say, hey, I'd like to pull my $25,000 out of my savings account because I'm going to go buy a new car. And the banker says, well, hold on a second. What if I give you that $25,000 to go buy that car, and we leave your $25,000 in your savings account, and we use that $25,000 as collateral on this loan that I'm going to give you to go buy the car instead. And so that way, your money's going to remain in your savings account, earning 4% interest in the savings account. And you're like, okay, that sounds good. So how much is the loan going to cost me to go buy the new car? And the banker says, well, we're going to charge you 6% on that money to borrow the money to go buy the car with it. And you say, okay, Mr. Banker, listen, I know when I come into the bank to do business with you, you guys have that little bucket of suckers over there in the corner that says dum-dums on it. I know you think that everybody else are dum-dums and you're making money off of everybody. I get how you bankers think. You're an evil banker. You're doing me wrong. There's no way that I'm going to pay you 6% while you're only paying me 4%. I'm just going to take my money out of that savings account and I'm going to go buy that car. And the banker says, hold on. Let me show you what I'm talking about. And that's what I'm going to show you right now. So check this out. You take that 25. So you say, all right, well, I'm going to take your word for it. I'm going to take the loan. So you take that loan. And then when you take a car loan, what happens? You start paying back that loan, right, on a monthly basis. So if we do the math on this, if we were to do a 5-year car loan at 6% for 5 years, your monthly payment would be $483. So at the end of those 5 years, you will have paid $29,000 back to the bank. Okay. Now, your savings account, on the other hand, it was sitting over there compounding over those same 5 years at 4%. So at the end of those same 5 years, that same $25,000, but compounding at 4%, that money actually grows to $30,500. So what am I telling you here? I'm showing you that the money sitting in the savings account compounding over 5 years, grew to $30,000, $30,500. But the car note over there, what was that? That was 6% simple interest. So simple interest versus compounding interest. This is just math, guys. You can get out a compounding calculator and do the math yourself. And not only is that 6% simple interest, but that's also a depreciating loan amount. So as you pay that loan off, the balance of that loan does what? It decreases. So your money, the simple interest is on a smaller amount, while the compounding interest over there is growing on a larger amount every single year. So what we were able to do is we actually made $1,500. Sorry, that skipped ahead very, very quickly. But we ended up making over $1,500 by paying 6% while only earning 4%. And I want you to keep that in mind, because a lot of what we talk about here tonight is going to talk about what's called the spread, and it's going to talk about what's called simple interest versus uninterrupted compounding interest. And that's going to make a lot more sense in just a second. But I just wanted to prove my point that just because you thought something wasn't the way that it actually was, and that you can make money paying more when earning less, depending on how that's structured and how that's set up for you. So again, keep an open mind. I just wanted to prove my point right there, right from the start. So what is the money multiplier method? So the money multiplier method is going to consist of 3 parts. You have the machine, you have the marathon, and then at the end of the day, you have the millionaire. So the machine, I'm going to show you in just a second what the machine is. The machine is simply the vehicle. It's the product that we use for this concept. Okay. The marathon is the concept itself. And then the millionaire is the result. If you use this machine and this concept properly, you will become a millionaire, and you will create a legacy for you and your family to make them millionaires as well. Okay. One thing I want to say before I move on, this is not a get rich quick scheme. This is not a get rich overnight scheme. This is a get rich, but it's going to take a little bit of time. Okay. And if you're willing to follow the concept and understand that it takes time, then this will work for you, because it's all guaranteed. It's been done for over 200 years. That's plain and simple right there. You're just following a process and a concept that's worked for thousands of other people for many, 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 many long, very long time. That's all. That's all we're talking about here. So the machine and the marathon will result in the millionaire. So what is this machine that we use? I alluded to it earlier. This machine is nothing more than a dividend paying whole life insurance policy from a mutually owned insurance company. Now, just to clarify, this is not a whole life insurance policy that you can go buy from, the guy down the street, your friend or your family member that you've known forever that sells life and health insurance and things like that. This is a very specially designed and engineered whole life insurance policy that's specifically built for banking. This is what myself and the Money Multiplier team do on a daily basis. So we build these policies, we design these policies, we help you with every single step along the way to get one of these policies up and running for yourself. So I just want to make that very, very clear. You're not just calling like a company like Mass Mutual or One America or Lafayette Life or Penn Mutual or Guardian. You're not just calling the company and saying, hey, I want one of those banking policies. This takes understanding of exactly what you need to do and what you're looking to accomplish to set this thing up properly for yourself. The best news is everything that we do, it doesn't cost you any money. We make a commission directly from the insurance company. So you never have any money out of pocket that goes directly to us. And we not only help you in the setup of it and creating it and making sure it works for you, but we teach you how to use it ongoing moving forward as well. So I mentioned that earlier, our mapping team. So we meet with you every 3 to 4 months. We're available to you anytime that you need. And we do all this at absolutely zero cost to you. You never pay us anything. So I just want to make that very, very clear. This concept is very well known in banking. So you guys can Google this later on. It's something called bank-owned life insurance, BOLI. You're going to hear a lot about that. So banks in the United States of America are the number one purchasers of whole life insurance in the world. So banks buy more whole life insurance policies than anybody else. Why do banks do that? Well, banks understand this concept. Banks understand how to make money. If you look at banks' M1 money supply, which is their liquid money supply that they put their money into, it's two things. Number one is whole life insurance policies, and number two is real estate. Do you think that there's a reason when we talk about wealth and financial education and strategies, why we teach this concept and we teach real estate investing? It's because we know how to make money. Banks know how to make money, and we're going to teach you how to make money as well, plain and simple. So I just wanted to get that out of the way right now. This is a specially designed and engineered whole life policy, and we will do this for you. So who else uses this concept besides banks? Well, Jim Harbaugh. Jim Harbaugh is a pretty well-known football coach. He currently is the head football coach for the Michigan Wolverines. But this was an article that came out in the November of 2016. And it said cash value life insurance makes Harbaugh college football's top paid coach. This type of deferred compensation alternative appeals to talented leaders and executives. So Harbaugh is using this to get paid. How about Joe Biden, President of the United States of America? This article came out in 2014. You guys can Google this stuff, by the way. In the second paragraph right here, Biden also holds 4 checking accounts, 2 of which he shares with his wife. In addition, he holds 6 life insurance policies with Mass Mutual. And they keep it private, but he's using these policies to store and generate wealth for him and his family. Very, very private. These policies are very, very protected. We'll talk about that in the future as well. Walt Disney World. Walt Disney wanted to start Disneyland, but after failing in his pursuit of traditional means of financing to build what would later become Disneyland, Walt decided to provide his own financing. A large part of this came to be by collaterally borrowing money from his cash value life insurance. The Pampered Chef, using $3,000 she borrowed from a life insurance policy. Home economist Doris Christopher started the Pampered Chef in her suburban Chicago home in 1980. By 2002, the company had grown into a $700 million operation and was later acquired by Warren Buffett for $1.5 billion. Ray Kroc of McDonald's. In 1961, he bought out the brothers. Kroc did not take a salary for the first 8 years. And to help with cash flow, he borrowed money from his 2 cash value life insurance policies to help cover salaries of his key employees, as well as the JPs, the Morgans, the Chases, the Vanderbilts, and the Rockefellers have all used whole life insurance policies to build and create wealth, not only for them while they're alive, but also to create and generate wealth for their families once they pass away and start creating legacies. And when you start getting to like the Vanderbilts, the Rockefellers, the Morgans, the JPs, the Chases, it's using this strategy in conjunction with things like 1041 tax reporting, specially designed trusts and charities to work in conjunction with these policies to make it all work together. So that's kind of next level stuff. We won't go into there right now tonight, but this is all stuff that you can do with what I'm teaching you here tonight as you build more and more wealth for you and your families. So let's take a quick look at, what banks do with your money when you put your money in the bank, and why it's so important for you to take back banking functions in your life. Stop making banks billions and billions of dollars and start putting that wealth and that money into your own financial life. So to understand that, we first have to understand how banks work. So because we're going to just mimic what the banks do, right? So let's say you have $100,000 to cash. Well, what most people are going to do is they're going to take that $100,000 and they're going to go down to their local bank, whoever they bank with, and they're going to deposit that money into a savings account or a checking account or a business account or whatever the case is. Whatever liquid accounts you can use them when you need it. Now, again, this is a magical bank. The interest rates I'm going to show you might be a little bit off, but again, we're just working off the spread. When you look at the actual spread, the spread's going to be about the same in today's terms. I'm just going to use this as an example. So you go to the bank, you deposit $100,000 in your checking account, they pay you 4%. But then you want to buy a home. So you go to that bank and you say, okay, I need a home loan. And the bank's going to give you a home loan at, let's say, 7%. So they take that money. You take that money, you go buy the house from the sellers. The sellers now have that money. And what do? They could have right back in the bank, just like everybody else does. And then you say to yourself, well, I got to buy a new car for my new house in the garage. So you go to the bank and say, okay, I need to buy a car now. So you get a car note and you go down to the car dealer, you give them the money. The car dealer takes that money. What do? They put it right into their bank account. So the bank says, okay, you need a home remodel loan now. So you get the home remodel loan, they give it to the contractor. Contractor puts the money right back into the bank. Now you write up some debt, let's say you need to do a debt consolidation loan, pay that money, pay those credit cards off. Credit cards take that money and put it right back into the bank. That's the circle of exactly how banks work. So let's add up the spread of what the banks made off of you. So on the home loan, they made 3%. And again, just as an example, if the bank pays you 0% in your savings account and you could go get a home loan at 3%, what's the spread? 3%. So it's all relative, right? All right. So the car, they make 4% spread off of you. The home remodel loan, they make 5% spread off of you. The contractor, they make 8% spread off of you. The debt consolidation loan, I don't even know I added that in there, but nonetheless, out of those 4 transactions, they made 20% off of your money. Is that right? Do you guys agree with that? They made 20%. Watch this. Again, math. They're paying you 4% in your savings account while they're making all this money. They made 20% spread off your money. How much is difference is 4% to 20%? 4 times 5 equals 20%. So what that means, the bank just made 500% returns off of the money that you are putting in the bank, sitting in your checking and your savings accounts. 500% they're making off of your money. So I ask you again, why are you making the banks rich? Why are you putting your money at a bank where they're paying you essentially nothing in a savings account and they're making 500% off your money? Again, don't take my word for it. Go to BauerFinancial.com. Bauer Financial is a research group that's been around forever. And all they do is track banks, how banks operate, what banks invest in, what kind of money banks make, everything about banks. BauerFinancial.com. And they'll tell you right on there. Banks make between 400 and 1,300% on money that you leave sitting there in your account. So let me ask you this question in another way. If you owned a hair salon, where would you go get your hair cut? Or if you owned a restaurant and you had friends in town, where would you take your friends to eat at your own restaurant, right? Or if you owned a gym, where would you go work out? At your own gym, right? I mean, if you ever go to a gym with a local owner, they're always in there themselves working out, right? So you go to the local gym. So if you owned a bank, where would you do your own banking? At your own bank, right? So why don't you own a bank? Well, that's why you're here tonight. So I can show you exactly how to start your own bank and take back. Stop making the banks rich. Stop making letting them make all the money off of you. Take back control of that money and let's make you rich. Plain and simple. So how are we going to start to do that? Well, one of the ways that we're going to teach you how to start taking back control and start making yourself rich is by, instead of giving away interest and your money to everybody else, like banks and finance companies and everybody else that's out there that's leeching off of your hard-earned money, you're going to start putting that money back into your own family's financial accounts. And one of the ways we're going to do that is we're going to start looking at how we're spending money. So again, we're not going to change anything about what you're already doing. We're just going to change where that money goes first. Instead of flowing into a bank like I just showed you, it's going to flow into your own bank. So watch this right here. If we take $1, on average, an American is going to spend 20 cents of every dollar that they make on automobiles, whether that's a car payment, whether that's gas, whether that's upkeep, whether it's just a purchase of the vehicle, whatever the case is. 20 cents of every dollar that you earn is going to go towards an automobile. 30 cents of every dollar that you earn is going to go towards housing. 40 cents of every dollar that you own is going to go to everything else: travel, entertainment, food, kids, whatever the case is. 40 cents of every dollar that you earn is going to go to everything else. So what does that leave us with? That leaves us with 10 cents of every dollar we earn is going to go towards savings. And I believe that number is actually a lot less right now. I just saw something that during COVID, the savings rate shot right back up or shot way up. And now it's really dropped far. And I believe it's dropped less than where we were before the pandemic. So that worries me a little bit. But on average, we'll just talk on average, 10 cents of every dollar that somebody makes is going to go towards savings. All right, so let's reverse engineer this. What does this look like? So if we start with the 10 cents in savings, very, very important, always pay yourself first. So let's look at the 20 cents that goes to the automobiles. On average, on average of the 20 cents that is spent on automobiles, 5 cents of that 20 cents goes towards interest. Okay. So what we're first going to do is, instead of paying that interest to the finance company or the bank, we're going to pay that interest that you're already paying anyways. We're going to pay that interest to ourselves. So that's going to go right into our family's savings account. So just by recapturing the interest on automobiles that we all buy, we all drive, we all own, and if you're buying automobiles cash, you're giving up the purchasing power of that money. And I'll show you in a second how to use this policy to buy cars. And I can prove to you over and over, we've done videos on this, how using this instead of buying cash makes all the sense in the world. So if you're a cash buyer, don't think you got me there. You definitely did not. But just by taking back the 5 cents that we were giving away to other people on automobiles and putting that into our savings account, we just increased our savings by 50%. Think about it. We were saving 10 cents before. Now we're saving 15 cents. That's a 50% increase in the savings just by changing that one thing right there. But check this out. Housing, 30 cents of every dollar you earn goes towards housing. Did you know that on average, 25 cents of that 30 cents goes towards interest? Let me explain what I mean by that. On average, a homeowner in this country is going to either purchase a new home, so get rid of their mortgage and get a new mortgage, or they're going to refinance on average every 7 years. Did you know that over 90% of all interest that's paid on a 30-year fixed loan is paid in the first 7 years? So if 90% of all interest paid is in the first 7 years, and on average, you're buying a new home or refinancing every 7 years, think about that for a second. All right. So we want to start taking back that 25 cents of every 30 cents on housing that we're giving to other people into our banking system. So we're going to put that into our savings account. And I'll show you how we do this in just a second. Don't worry. And then of everything else, on average, 5 cents of everything else goes towards interest payments. So we're going to take back that 5 cents as well. So by not doing anything different except where our money flows first and using our own bank to finance these purchases, nothing else different, we were able to increase our annual savings from 10 cents. Let's add it up. We did 5 cents on this one. We did 25 cents, so a total of 30 cents, and another 5 cents on that, 35 cents. So we went from 10% to 45% by doing nothing different. How would your savings look if you were saving an additional 35% every single year without doing anything different? So how do we do this? How do we get back all the money for our purchases? Let me show you. How do we get back all the money for every dollar we ever spend, for every car you'll ever buy, drive, and own in the future? So let's take a quick little look under the hood, so to say, right? Buying a car. But let's take a little look under the hood of this whole life policy, of this machine that we're using to do this. So over here on the right is what we call a money multiplier illustration. So it's going to show you how much money, what year of the policy it is, how old the individual is, how much money is going into the policy each year. Now, a couple things on this. You'll notice how this says deposits right here. Well, think about it. This is a whole life policy. So these are premiums that are going in. But premiums kind of has like a negative connotation to it, right? Like if you are obligated to pay something in premiums, you're not really going to want to do it. But if you go down to your local bank and you're all excited because you have a paycheck or you made some money on an investment or something like that, you're excited to deposit that money into the bank, into your bank account, right? So why wouldn't you get excited about depositing money into your own bank account? Well, you were once you start to change your mindset a little bit and you start to understand how this works. So right now, I want you to start thinking immediately, these are not premiums going into your policy, into your new banking system. These are deposits that are going in. Okay. So I want you to make that little change right there, right now. Second, the amount of money that's going into this policy, it doesn't matter. You could put 10,000 a year in, you could put 10,000 a month in, you could put $1 million a year in, you could put 500 bucks a month in. It doesn't matter. What we're going to recommend to you for your first policy as a guideline minimum would be 10 times your age on a monthly basis. So if you're 30 years old, 300 bucks a month. But one of the things that we're going to do on our initial consultation, so what you're going to do is you're going to schedule a call. We're going to spend 30, 45 minutes together talking through this, what works for you financially, what that looks like. So we'll talk about your personal situation, but I just want you to understand, this is your choice. How much money I will never, nobody on my team will ever tell you how much to deposit into one of these policies. It's completely up to you. Also, the other thing I want to mention is this guy's 26 right here. Age doesn't matter. I started a policy for my son when he was 5 years old. Chris started a policy for his daughter when she was 6 months old. I start policies for people all the time in their 70s. So it doesn't matter. Age does not matter. And if for some reason you cannot qualify because of age or health or something like that, we have alternatives for that as well. So make sure you ask me and I'll explain what we can do with that. We can use somebody else's life where you still have control of the policy, where you use it for banking. It's just on their life. So that doesn't matter either. And the death benefit, there is a death benefit on these policies. That's not why we do this. We do this for the banking principles and using these for banking. But I want you to understand there is a death benefit, and that death benefit will be paid out to your beneficiaries completely tax-free. You won't hear me talk anymore about that here, but we do build these policies for banking, but there is a death benefit associated with them. So just wanted to kind of point out a little bit of what it looks like under the hood of these policies. Over here is the cash value growth. I'll show you in just a second. And of course, the death benefit. All right. So let me show you what that looks like in the real world. So this policy right here, like I just showed, this young man was going to put $10,000 a year into the policy. So he starts putting $10,000 a year. In the first year, he has about 6,000 of the 10,000 available to pull out for loans. The cash value is the amount that's available to you to be able to use in the policy. Again, when we use money from the policy, it's coming out in the form of a loan. That's what allows it to remain in the policy, compounding and growing for you at all times. So the policies we design now are a little bit stronger, so we get higher cash value right away. But nonetheless, this works unbelievably well, even with this right here. So 10,000 goes in the first year, 5,800 available that they can use. 10,000 goes in the second year, the policy grows. Now it's 12,000 available. So in the third year of this policy, they say, okay, I want to use this to purchase a car. So they take a loan from the cash value of $25,000. And then, like I showed you before, anytime you take a loan from the bank, you're always going to repay the bank. Well, when you take a loan from your own bank, doesn't it make sense that you're going to repay yourself as well? Absolutely, right? Now, I'll talk in a minute. You don't have to repay yourself. You set the terms. You're the bank. You're your own banker. So you decide what that looks like. But for this example right here, they're going to pay back that loan just like they would any other loan. So they're going to pay back $6,000 a year for the next 5 years. So at the end of the day, we put $10,000 a year into this policy. We took $25,000 out of this policy, and we recaptured another $30,000 into it in the loan repayments. So we put a total of $75,000 into this policy. Now you'll see over here, the cash value of this policy. We put in 75,000. We now have almost $68,000 available. So we have 91% or 91 cents of every dollar we put into this policy, we now have available back to us to use again. What else do we have, however? We have a vehicle sitting in our driveway that's completely bought and paid for. that we don't owe any money on. It's completely paid for, sitting in our driveway, and we recaptured 91% of every dollar that we used to purchase that car, we recaptured back to ourselves. Now, I've bought a lot of cars in my life, but I've never bought a car where 5 years later it's worth 91% of the value that I bought it for, right? Because recapturing that money, I've now basically had that car recapture the money that I spent to buy that car, 91% of it. Plus, I have the vehicle that's sitting there in my driveway that I can sell, I can continue to drive, I can do whatever I want with it, right? But again, these policies don't stop. They continue to compound and grow year after year after year. So this thing keeps going. Now, in the real world, we would continue putting money into our policy through premium deposits. There's no reason you would ever want to stop, because every single year that you have this policy, the uninterrupted compounding interest, the efficiency of the policy gets stronger and stronger and stronger every single year. So you never want to stop putting money into this thing. But just for this example, I wanted to show you how this works. So we stopped putting money into this policy, but we decided to buy another car. So in the 8th year of this policy, I take another loan out for $25,000. And then, just like before, we recapture the money back into the policy. So over the next 5 years, we put no new premium deposits in. We put in $30,000 in recaptured money, and we took $25,000 out to buy the car. You'll see right here, our cash value of this policy grew from $67,000 to over $91,000, over $23,000 in growth. And I put no new money into this policy, like, because I put $5,000 into it, but it grew by $23,000. So what does that tell me? I now have 2 vehicles bought and paid for, sitting in my driveway that I paid $50,000 for. And I have $91,000 sitting in my account, ready to go do whatever I want with it next. Buy another car. And if this works for cars, what else does it work for? So having $91,000 sitting there, I bought 2 $50,000 vehicles. What does that tell me? It tells me that I've now recaptured all of that money that I spent to buy those vehicles, and I will continue to do so for the rest of my life. So there's 3 rules that we need to follow to make this work. Let me show you those rules. Rule number 1, always pay yourself first. So that $10,000 going into the policy, that's important right there. You want to continue to fund your banking system. Number 2, pay yourself with interest. So just like if you borrow money from somebody else, pay yourself back with interest, plain and simple. Number 3, always recycle and recapture your money. So like I said before, you don't have to repay that car. The terms you set, you're the banker, that's up to you. But let's become an honest banker, and let's always recycle and recapture our money so we can do it over and over and over again. But here's the difference. Let me explain the difference. If I was going out there and I was to buy a car right now, and I was to finance it with Ally Financial, let's say, and next year I just decide, hey, for whatever reason, financial trouble, I just don't feel like it, whatever, I'm just not going to pay my car payment for a few months. What do you think is going to happen? Well, Ally Financial send probably some burly looking dude with a bunch of tattoos and a tow truck to repossess my car. So I'm going to look out there in my driveway one day, and there's going to be a tow truck hooking up to my car, and they're going to take it away. They're not stealing it. They're repossessing it because I didn't pay my bills. Perfectly legal, right? Now, I borrow money from my own bank next year for whatever reason. I don't want to pay back that loan for a few months. What's going to happen there? Nothing. Because me as the banker, I'm going to say, okay, Steven, I cut you a little bit of slack. You can continue the payments in 6 months. You can continue the payments next year, or maybe you never have to pay me back. I'm going to forgive it all. You never have to pay me back. Don't worry about it. You can keep the car. Nothing's going to happen. It doesn't matter. You're in control. You're the banker. You set the rules. You set the terms. Do whatever you want. But we're always going to encourage you to do infinite banking the correct way and recycle and recapture that money. Now, if this is later on in retirement, this is, down the road where the policy is very, very efficient, let's say 10, 12 years from now, 14 years from now, 20 years from now, whatever, Hey, that's a different story. But in the early years, especially, those three rules right there are going to be important for you. And again, if this works for a car, what else can it work for? Now, let me show you another way to start recapturing your money using debts. This is how you're going to pay down your debts, get yourself out of credit card debt, whatever the case might be, while still continuing to build wealth and paying off debt a lot quicker than otherwise. Check this out. All right, another great example. This is, again, these are all real case studies. These are real people and real cases over the years that we've done for people. So this guy right here was a chiropractor and one of Brent's clients, and he was a doctor, a chiropractor, and he made good money, had a chiropractic clinic practice. And when you make good money, sometimes you end up spending a lot of money too, right? And so this guy ran up a lot of debt, $478,000 in third-party debt. And so what we did is we did a cash flow analysis with him, and we looked at all of his debts, and we created this what you see on the screen right here. So each one of the debts, how much is owed, the monthly payments, and we're going to do this with you too. This is what our mapping team does. I'll show you that in a second. But so what the APR is and what those payments look like. So if we were to add all of this up, he was currently paying $5,700 a month to third-party debtors, a total of over $69,000 each year. So if we were to add this up, it would have taken him over 19 years to pay off $478,000 in third-party debt following the plan that he would have otherwise, 19 years. So let me show you what we did for him. We created a money multiplier debt map. Well, first we created the policy for him. The policy was $25,000 a year. And then we created this debt map. So all he had to do was follow the plan. And let me show you how quickly we eliminated this debt for him while continuing to build wealth. So you put $25,000 in the first year into this policy. The first year he had cash value available to pull out for loans of just under $15,000. Again, the new policies we're building are much higher cash value. So your cash value year one might be $20,000, $22,000, maybe more if you want to do a dumping or something like that in there. But just for sakes, I always like to under promise and over deliver. Let me show you how powerful this works, even using this policy right here. So 15,000 available. So what we do is immediately we take a loan from that policy of $15,000. We pay off the Discover card, we pay off the Lowe's card, and we pay off some of the Nordstrom card. So what that does is that eliminates $161 and $287 that previously were going to Discover card and Lowe's. Now, what we're going to do, what I mentioned before, rule number 3, we're going to recapture and recycle that money. So what that means is that $448, the $287 and $161 we were giving to Discover and Lowe's card before, what we're going to do is instead of paying that $448 a month to them, we're going to pay that $448 a month back to ourselves. So what we're going to do is we're going to teach you how to open up what's called a segregated bank account. And this segregated bank account is nothing more than just a separate checking account that we can use for infinite banking. So when you take a loan, it's going to go into the segregated bank account. From there, it's going to go to pay off these debts. And then from there, we're going to start paying ourselves back. So that $448 that we were giving to Discover and Lowe's, we're now going to put into our own segregated bank account and let it build up inside there for us, okay? Our own banking system. So what happens here is we do that for an entire year. Then in year 2 comes along. We put another $25,000 annual deposit into the policy. Now, the second year, they have a little bit more available. Again, each year, you're going to have more and more cash value available for the rest of your life. It becomes stronger and stronger and stronger. So the second year, $16,000 available. So we take a loan for $16,000. Now we have the recaptured payments of $448 a month over that year, a total of $5,374 for a total of $22,000 in cash that we can now deploy from our segregated account to pay off more debt. So we pay off the Nordstrom card, the Wells Fargo card, the private loan, and we reduce the balance of the BMW a little bit. So what do we do now? Well, just like before, we take all of that money 276, 271, and 922 that we were giving to Nordstrom, Wells Fargo, and the private loan. And instead, we pay that back to ourselves into the segregated bank account. So now we have 1917 a month going to our segregated bank, and we have 3860 still going to third-party debtors. So year 3, 25,000 goes in, cash value grows by over $25,000. So we take the $25,000 loan, we take the $23,000 that we recaptured through these payments, and we take that $48,000 in year 3, and we pay off the BMW, we pay off the West Marine card, and we reduce the balance of the condo. $3677 going back to us, $2,100 going to third-party debtors. Now, let me make sure you guys are following. So far, we put $75,000 into our policy. We took loans out of $14,000, $16,000, and $25,000 for a total of $55,000 out of our policy to start paying off debt. So how much is still in the policy? Let me see how much you guys are still in the chat box. How much is left in your policy? Let's see who's still paying attention right now. Raul says 75,000. So guys, I put 75 in. We pulled 55,000 out to pay off all that debt. How much is left in the policy? Jermaine says 75. Madeline says 75. All right. I love it. I love it. I love it. Leilani says 75. That means you guys are following and you guys are paying attention. So good job. Congratulations. Because a lot of people, when they first see this, they think, well, I must have $20,000 in there, right? Nope. You guys had it absolutely right. $75,000. And just to clarify that, it's because when we put money into the policy, we take a loan from the policy. We are actually borrowing the insurance company's money from their general account, and we're using our policy as collateral for that loan. So that allows the whole $75,000 to remain in the policy, compounding uninterrupted for the rest of your life. So very, very good. Thank you guys for paying attention and following along. All right, year 4 of this thing, same thing. Pay it down. Now in year 4, we didn't have enough to pay off the condo, so we didn't recapture any new money. It was still at 3677, but nonetheless, we get to year 5. Same thing. We now have enough money to pay off the condo and reduce the amount of the house. So now we get to year 6 of this policy. In year 6 of this policy, look at what happens. Each policy design is a little bit different. So this usually now happens after year 11 in the policies that we're doing. But in this policy for this guy, in the 6th year of his policy, the amount that he was able to put into it was reduced down to 10,000. So the first 5 years, he put 25,000 a year in. And then in the 6th year, he was only able to put 10,000 a year in after that. And the reason for that is something called MEC rules and regulations. M as in mom, MEC. It stands for Modified Endowment Contract. And MEC rules and regulations are something that the IRS sets. And it's what we work within when we build a policy, when we design a policy. And it's, you know, the performance of that policy and how much you can put into it is determined by that MEC limit. So you never want to MEC a policy and put too much in it where it MECs it, because it can make it taxable and all that stuff. So that's why he was able to put 25,000 in the first 5 years, and it was forced down to 10,000 starting in the 6th year. Again, that amount for you is going to drop down somewhere between like the 7th and 10th year, but it will drop down, just to be aware of that. But what we can do to counteract that is we can start more policies. So you can have essentially as many policies on yourself as you want, as long as you can qualify for them. So for example, Brent Kessler now has like 22 policies. Chris has like 19 or something. You know, I now have 3. I'll be starting my 4th later this year. So you just start adding and stacking policies as you grow financially and grow your banking system per what the MEC limit is for your existing policies. So in this one, we now have a first policy with 10,000 a year going in, and a second policy with another 25,000 a year going in. Now you'll notice the cash value He puts 10 in and it's now over 13,000 because again, these things become very efficient. That's a 30% cash on cash return on his money that year, tax free within the policy. But the second policy is starting from the beginning. So it takes a few years for it to become efficient and get to this level. So they're starting back at 15,000, right? But nonetheless, those are the recaptured payments that we had that year. Total cash of 82,000. We now in the 6th year, not 19 years, in the 6th year of having this policy, we were able to pay off all of that third-party debt that would have otherwise taken 19 years. Now that that third-party debt is gone, what do we continue to do with that $5,000 in monthly payments? Well, that money's now going to go back to us and our financial system and for our family in the future instead of third-party debtors. And we'll continue to pay ourselves back until we replenish the policy or start to put that money out to other uses. Because if this works for debt, or if you don't have any debt, what do you do with it at that point? And that's the question, right? What if you don't have any bad debt? What happens once you pay off that debt? What if you don't need to buy a car? Should you still become your own banker? And the answer is hell yes. That is where the fun begins. And that's when we can really start building wealth and creating a legacy. And I'll get into that in just a second. But before I get there, just real fast back to the debt map. Again, we do all this for you. Once you have a policy, our mapping team is going to create that plan for you. We update with you regularly, and we'll do that exact same thing we did. And again, it doesn't cost you anything. It's all free of charge just for being a client with us. Think of this as your financial GPS. Where are you now? What does your situation look like now? Where do you want to go to? What does that look like for you in the future? What's retirement look like? Or what's your financial future look like in the future? How's the fastest way to get there? And let's create that financial GPS, that financial game plan to get you there. And that's what this is all about. So let's get into a little bit of fun with this. How do we start creating wealth multiple ways? Well, this is all stuff that we teach in our trainings. Like I said, through Money School before, on our webinars that we do, in our live and in-person event at the end of July in Buffalo, New York, the virtual Money School trainings. We teach all these different types of strategies, notes, investing, crypto, options. But right now, one of the most popular and secure ways to grow wealth, in my opinion, is private lending. And we have a lot of people that are using policies, taking money from the policies and lending it out on these private money deals. It's passive, 10, 12, 15% returns. It's protected by a hard asset in real estate. There's a lot of private funds out there right now that you can do, like commercial deals and apartment complexes and mobile home parks. So a lot of different ways to create wealth. And you don't have to pick one. Let's create wealth multiple ways, right? But this is how you can use this stuff in conjunction with this new banking system. If you don't have debts or you don't need to buy cars and things like that. So let me show you the way that works. But there's 2 laws for creating growing wealth that I've learned over the years. These are very, very important. Write these down or take a picture. Number 1, compounding interest, the 8th wonder of the world. Those who understand it, use it. Those who don't, pay it. And then how about uninterrupted compounding interest for the rest of your life? And that's what this policy creates. Number 2, keep money moving at all times. Money sitting still is losing money. Money in motion is making more money. So we want to get the money in the policy. We want to immediately get the money out of the policy and put that money to work. Whether it's in a purchase where we're recapturing the interest, whether it's in an investment where we're making the spread while the money is simultaneously compounding and growing over here. Let's get that money moving and making more money right from day one. So here's some examples of using this for using your private bank for something like private money lending. And this is an actual illustration. This is a policy I did for a 40-year-old lady. This was a woman. And you'll notice right here, these are the premiums, the deposits, right? We can put more money in the first year. So we call this a dump in. So if you have money sitting right now in a savings account, maybe you cashed out of some stocks or a business, maybe you have equity in your home, you want to tap into something like that, you can dump in a larger amount the first year up front, jumpstart that compounding interest. You'll have access to like over 90% of it to pull it right back out. I mean, look at this right here. In year 1 of this policy, they put $150,000 in. The cash value available is $132,530. So that's a lot of money that they can pull out and put to work for themselves. I mean, look at this. In the third year of this policy, they put 50,000 in. They're already in positive cash on cash territory. They're pulling more than $1 back out starting in the third year of this thing. And look at how that thing grows over time. I mean, in the 12th year of this policy, 52 years old, she puts $17,000 in. It grows by over $47,000. That's like a 300% return. It's just insane how these things start, the efficiency of these when they start compounding and growing. So just keep that in mind. We can do a dump in the first year and really get this thing rolling. They want to do 50,000 a year. Again, it's up to you. How much you put into this thing, you tell us how much. Here's another policy. This was $50,000 dump in and then $500 a month. In the first year, they had over 51,000 in cash value available. The second year, 21% positive returns. I mean, this thing really starts killing it too. So just to give you some different examples of funding amounts and what these things look like. Here's an example of what the flow of money looks like. So here's your policy. This is your whole life policy over here. Take a loan from the policy. You're going to pay 3 to 4% or so to the insurance company for that loan. The money goes into a segregated account. Then you're going to loan it out. Let's say you do a deal, a private money deal in Private Money Club, where you earn 12% on your money. You're going to make the spread. So you make the difference between 12% and 4%. That's what you're keeping. And then as the profit, and then you just recapture it back into the policy. So you can do it over and over again. This is kind of that circle I was talking about before. Do that circle over and over and over again. Keep that money moving at all times. So here's an example. So this is a private money deal that they wanted to do. So this is an example if they were to use their money from their policy versus money from a bank. Because either way, if you're going to lend money, or if you're going to lend money to somebody on a deal, you're either going to get that money from a retirement account, you're going to get that money from a bank account or under your mattress, or you're going to get that money from one of these policies. So if I was to do a 12% private money deal and I get that money from my checking account, I'm going to make 12% returns on it. Let me show you the difference. If I was to take that money instead from my bank, I consider this my bank account now, but my private banking policy, as opposed to a traditional bank account like at Wells Fargo. Watch this. So first off, when I put money in the policy that year, instead of a traditional bank account at like Wells Fargo, my money immediately grew by 37%. So you guys can do the math on this. I put $48,000 into my bank that year, and it grew by $66,000. That's a 30% return on my money that year, cash free, tax free. Okay, you guys check me on that. 30%, 7%. What is your account if you go deposit 48,000 at Chase right now, or at Wells Fargo, or at Trident, or whatever these new banks are called? What are they paying you in a savings account? 0.1%. Well, mine grew by 37%. Check this out. So I do the 12% private money loan. Let's say I paid 5% to the insurance company, which is what this policy was charging at the time. 37% I make, the growth within the policy. So instead of a 12% return on our money, we made a 44% return on our money without doing anything different except where the money goes first, into our bank instead of somebody else's bank. So ask yourself, would you rather make 12% returns or 44% returns? You're not doing anything different. You're not working any harder. You're not taking on any more risk. Where are your money going first? What would you rather do? This is the power of becoming your own banker. And by the way, we didn't really talk about the death benefit. I mentioned it earlier, but the death benefit is paid out tax-free, creates that legacy for you and your loved ones. The loans never have to be repaid, I mentioned earlier. Internal values are growing tax-free within the policy. They're very safe. So they're exempt from judgments and liens in most states. There's tons of business uses. You can lend money to your business. You can create company-owned policies. Ask me about that. I'll tell you all about that when we talk. Kids policies are unbelievable. Again, I can send you examples of kids policies and what those look like, but the power of those are really, really good. But not only that, but guess what else you're doing? You're teaching your children the power of this concept. Imagine if somebody would have taught you this when you were 10 years old, 15 years old, 18 years old, 20 years old? What if somebody would have started a policy for you, taught you how to use it, and then how you earn taking over control of that policy? What would that look like for you? Why don't you do that for your children? So not only did I start a policy for my son last year, but my plan is to teach him how to use this. So when he wants to buy something, let's say he wants to buy a new PlayStation or something like that, something silly, right? Well, guess where he's going to get the money? From this policy. And I'm going to teach him these principles. When he wants to buy a car, guess where the money's going to come from? The money's going to come from his policy, and he's going to recapture it. And he's going to bring it back. College, whatever he wants to do in life. It's a beautiful thing, teaching other people how to do powerful strategies like this. So why aren't more people successful? Doing what you've always done, following the status quo. So how about we start doing what the wealthy do? Do what the banks do. I think it's time. Buffett said it best. If poor people would just do what rich people do, they wouldn't be poor anymore. So just ask yourselves these last two things right here, and we're going to wrap. Number one, when you're alive, are you better off with or without one of these policies? And once you pass on, you graduate, you die, are you better off with or without one of these policies, your family? So guys, join the movement, take back control of your financial situation. Go to the site right here, moneyschoolrei.com/Snagy, SNAGY. Just put in your name, email, and I will automatically send you a copy of Mapping Out the Millionaire Mystery, the Private Money Guide, and some other secret bonuses that you're going to get as well. So go on there, or if you prefer, send me a text message or an email. I'll send you my link to get a call scheduled. I'll send you those bonuses as well. But go there right now, get a call scheduled. Let's talk about your financial situation. What's that look like for you? And let's get you started banking. So with that being said, if you guys have any questions, please put those in the Q&A box right now. I'll answer those. And then I look forward to talking with all of you on the phone and helping you guys get these things started. So it looks like I did a pretty good job so far with questions. There's none coming in. Mark asked one, is money borrowed against the purchase of your primary residence tax deductible? Is money borrowed against the purchase? I guess it depends how that was set up, Mark. So maybe let me know more details on that one and I can talk to you about it. Thank you, John. And John, your policy's ready. They had to do some differences, your new one. But I talked to Patrick and Sarah and Hannah and Chris about it today. It should be ready any day for issue. They just had to make sure that your funding amount was right. Lana, thank you very much. Mahalo. David, yeah, we can load these things up for sure. Just give me a shout, David. Like I said, go to that website right there, moneyschoolrei.com/Snagy. My call calendar is right on there, so you can schedule a call. Or if you need to get something after hours in the evening, something like that, just email me or text me. We'll get a call scheduled. Let's see, Jermaine, when taking policy loans, do the premiums paid to loan go back to my account or the insurance company? So when you recapture the money, Jermaine, it's going to go to your segregated account. And then from there, it's going to go right back into your cash value policy or right back to the insurance company. And it's going to replenish the cash value bucket of your policy, so to say. Ricardo opening his third policy. Awesome. All right, guys. Well, if you need anything, please reach out to me, schedule a call. Let's talk. And appreciate everybody being here. Hope you guys have a great night. Have a great week. And we will see you tomorrow. Let the F Happen starts at 9:30 a.m. I'll be on with Larry Steinhaus. I have Vendi and Ivan, and I believe somebody else joining me with Philanthro Investors, talking about passive income with real estate, as well as passive income with solving a problem in this world, which is clean and safe water. So join us at 1 p.m. tomorrow to learn about that. And Thursday, we'll have the webinar on business building and precious metals. So we'll see all you guys soon. Have a great night. Thank you very much.